Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. You know, I just love Mondays. Why? Well, the market's back open and I get to talk to all of you. Very exciting day for me. So what do we got going on in the markets today? Well, we're up about 350 points on the Dow, about 130 points on the Nasdaq. So a big up day, right? A big up day. Now, do I think that this market's going to crash? There's a lot of people talking about a market crash. Yes, I do believe eventually the market's going to crash, but I really don't think it's time yet. I mean, so many signals are still telling me that this market's going to go higher. Now, we've come up to the resistance level at the 50-day moving average. The 50-day moving average is resistance. We have to get through that to go up higher. Now, my call for the S&P that we're going to go up and we're going to hit about 4,500 on the S&P, right? Okay, I mean 125 points is all that is from today. So we got a little ways to still go up before we start to go down, and we're going to start to go down. This market's weak. It's going to come in, but right now we just started earnings season. The earnings are expected to be very strong, and this is going to push the market higher. You're going to have corporate buybacks. They're going to be buying back stock. That's going to push the market higher. We're coming into a strong season, the season of the holidays. We got Thanksgiving, we got Christmas. This all tends to push the market up higher. We got through the bad part. We got through September. We got through the first couple weeks of October. These were the bad parts. And we came down in September. We did. But right now, it looks to me like the market's going to go higher. Now, this may be completely different from your take, and that's okay. Let's get over to the real estate market now. Real estate market, it always fascinates me. We got Goldman Sachs. Now, Goldman Sachs, they expect prices to rise. House prices to continue to go up, they say. And they say because of the low inventory, that guarantees that there'll be no repeat of 2008. Well, let's think about this. Goldman Sachs in 2008. Did they get things right or did they get things wrong? Oh, they got things extremely wrong. But Mike, it's different this time. Now, it's different this time until it's not. But in 2008, Goldman Sachs got things really wrong. Goldman Sachs almost went out of business. The only reason Goldman Sachs is here today is because the U.S. government bailed out AIG. AIG owed Goldman a lot of money. They paid Goldman the billions of dollars, and Goldman got to stay in business. So that's how it worked back then. So they were wrong back then, and I think they're probably going to be wrong now. But their plan is that the houses are going to continue to rise, and there's not going to be the repeat of that 2008 thing because we have low inventory. You see, I know my view's not popular, but here's my view on that. My view is because we have low inventory, not only will it be a repeat of 2008, it will be much greater than 2008. But Mike, that doesn't make any sense. There's no inventory. Right, there's no inventory and prices are still coming down. Why would they be coming down if there's no inventory? Well, the fact is that there's no buyers. The buyers are gone. And when the inventory comes, which I guarantee you it will, it's going to send this market into a tailspin. It's going to be going straight down. Now, right now, it's just a slow drift downwards. And it's grinding out, a slow drift right now. You can still get close to the price Billy Bob got. But that's not going to last much longer. Once the inventory hits, this market is going to go into a free fall. Everybody's going to be dumping it on the market at the same time. A lot of old people, a lot of the boomers, they want out and they're waiting for the Fed to lower rates so that the market goes back up. When the Fed lowers rates, it's going to be too late because that's what's going to send the market lower. The Fed's going to lower rates for a reason. For a reason, it's going to be job losses, recession. That's all coming. Yes, it's postponed a little bit. It'll probably start towards the end of this year. We're noticing the layoffs now, but 2024 is going to be a horrendous horrendous year for the real estate market. I would not go with that Goldman Sachs that they believe that the market's going to continue to go upward in 2024. I'll bet against that. I'm betting against Goldman Sachs right now. And you got other banks. Well, Goldman Sachs not the only one, but now Jamie Dimon, he's being a little more honest at JP Morgan, okay? He's saying these are the most dangerous times he's ever seen in the financial world. And I tend to agree with that. It's dangerous times. He's warning that the debt bubble is on the verge of collapse. And I do think that the debt bubble is going to collapse. I think that's going to be a big problem. And we're seeing that right now in that bond market, right? Bonds are going down, which means rates are going higher, right? And now everybody's looking for a scapegoat. You see Jamie Dimon, his bank's in trouble. He won't tell you. They just came out with record earnings. But they don't have your money. They've already lost your deposits. Your deposits are already gone. That's the problem in the banking system. They don't have your money anymore. They invested it and they made bad investments and they lost your money. So they're in trouble. So they're looking for the scapegoat. Now he's going to blame it on the debt crisis, right? He's going to blame it that the debt market's going to collapse. That's the scapegoat for him. If the government didn't get in so much debt, then his bank would be fine. And the government's saying, well, we got in so much debt because we go into war. You see, the government's looking for the scapegoat. It's got to be the war. Everybody's looking for the scapegoat because they don't want to blame themselves. Couldn't be the Federal Reserve's fault. That's impossible. They want to stay in power. Everybody wants to stay in power. So, Jamie Dimon is blaming the government. The government's blaming the war. And the central banks, they're saying that, hey, they've lost control of the yield curve, right? So they can control this short end, right? That's what when they come out with their interest rate announcements, okay, we're going to raise by 0.25%, we're going to lower by 0.25%. That's on the short end of the curve. This long end is rates are starting to go up, and that's sending the bonds just free falling. And what the central banks are saying now, it's not our fault. It's not our fault. We have bond vigilantes. Bond vigilantes, really? That's their scapegoat, is bond vigilantes? Okay, maybe. Anyways, a lot of people are shorting the bond market right now because they believe that no one in their right mind is going to loan the government money, even at 4 or 5%, when the real rate of inflation's running 10 or 11%. And inflation's going to continue to run hot. So there's kind of a negative real rate right now. There's a negative real rate. You got the bonds paying 5%, but you got inflation, real rate, not the rate they tell you. If you measure inflation like they did in 1980, it'd be about 10%. You can go on shadow stats. I'm not making this stuff up. That's just reality. You measure the way we did back in 1980, well, what you got? You got about 10%, and you got the bonds paying 5%. So you take that 5% minus the 10% inflation, that's a negative 5% real rate of interest. So a lot of these bond vigilantes are saying, hey, we're going to tank this bond market because we can't believe that people are still loaning the government money. I mean, right now, the government, oh my goodness, they're running a $2 trillion deficit this year. This year, we're going to run a $2 trillion deficit. Now, I mean, I guess we're at war. Who knows? I mean, we finance the wars, but there's no reason that we should be spending $2 trillion more than we take in. We got to learn to live within our means or something's going to break. And it's going to break anyways. We're beyond the point of no return. So let's just go with the modern monetary theory, right? You can print as much money as you want. It doesn't do any harm. You just keep printing more money. It works. That's what they teach kids in school nowadays. They didn't teach us that. I was an econ major. They never taught me about modern monetary theory. I would have laughed at that. I would have probably dropped out of school if they started teaching me stuff like that. So maybe it's good that they didn't teach me that stuff. That's what they're teaching now. Modern monetary theory. So this is $2 trillion deficit that the federal government's running. It's never been bigger. This is a record. This is an all-time high. We've outdone ourselves. Isn't that great? Oh, it's fabulous. All right, so we got this other article came out, right? Other article says that basically home buyers are putting more money down. And the gist of the article was, well, we can't have a crash because look at the buyers are now putting down more money, which gives them more of a cushion, more equity, if you will. But this article is very convoluted. I had trouble understanding their philosophy here. But anyways, they say that in 2019, the average amount someone would put down to buy a home would be $14,000. And today, the average amount is $30,000. Okay, well, that probably makes sense. Prices went up, right? I mean, the home prices went up they went up by about 50%. I mean, maybe a little more in your area, maybe a little less in some areas. Some areas doubled. I get that. It's all over the road, but that's just called 50%. So, okay, the money that they have to put down would be more, right? But the article went on to say that the down payment average went from an 11% to a 15% down payment. 15% down payment. Now, if the average is $30,000 down, and that's 15%, they're talking about these about $200,000 homes in the article. I don't know where these $200,000 homes are now. A mobile home here costs more than $200,000. So anyways, there are examples. It just didn't make any sense. But there is a reason that people putting more money down, right? Okay, some of it is because they cannot qualify for the loan. So the bank is now requiring people to put more money down. Okay, that's a possibility, right? A lot of people like to put 20% down. When I was a young whippersnapper out there buying houses, flipping them, fixing them up, I'd have to put 20% down because no one in their right mind would give this young kid a loan, right? But if you had 20% down back then, if you were breathing, they'd give you a loan. It's called the no income qualification. No income qualification. They didn't care what I made. They didn't care that I didn't make money because I was going to make money flipping the house that they were giving me the loan on. So I was very fortunate that they had that program in place, but that's why I put 20% down. So maybe a lot of people can't qualify now and they have to put more down to qualify. Now, if you don't put 20% down on a property, right, there's a thing called PMI. It's mortgage insurance, right, where you got to protect that lender in case you default. So if you put less than 20% down, they're going to charge you an extra fee on your loan called PMI. Okay, well, so a lot of people want to get rid of that and put more down. Now, rates are higher now. When rates were down here at 2.8, I know so many of you locked in at 2.8. That's great, man. That's great. You're in your forever home. You're never selling. You're going to stay there. You're going to die there. It's going to be fabulous. But anyways, a lot of people are locked in at that. But when rates were 2.8, you wanted to put down as little as possible. I get that because that's very attractive now. Rates up here closer to 8%. People don't want to pay that 8%, so they put more money down to make the amount of their payments less, right? And a lot of people today, the ones that are still buying houses, see, the housing market's kind of locked up. Nobody can afford them. The people that can afford them right now, they have a house that they sold and they're relocating. They're taking that money and they're rolling that money into the next house. And that would make up for why a lot more money is going in. But this cushion they're talking about, equity they're talking about, that can be wiped out in a heartbeat. It can be wiped out. It's going to be wiped out. It is being wiped out. Look at foreclosures are going like this. I don't know if you're aware of this. Foreclosures are skyrocketing. We're at over 100,000 a quarter now. We were like in Q2, we were at like 70,000. Right now, we're over 100,000. We're back to pre-pandemic numbers on the foreclosure front. Now, why would anybody be getting foreclosed upon in these marvelous times that we have? Everybody's got money. Everybody's got equity. Why don't they just go and sell their house? Why is there 100,000 foreclosures a quarter? I really don't get that, but could it be because a lot of people are already underwater? A lot of people have negative equity in their house. According to CoreLogic, over 1 million people have negative equity in their house. So when you have negative equity, maybe you just get tired of making your mortgage payments. Maybe that's why there's 100,000 foreclosures per quarter now. And these are skyrocketing. They're not going down. The direction is up, 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 up. But these are great times. Don't worry. There's not going to be a crash. 2008, that's way behind us. It is way behind us. things are going to come down much more this time. 40, 50% down. That might be conservative. If we get a freeze up in the credit market, I mean, that might really be conservative. Now, it really is shocking to me. I talk to my friends over the weekend. I go out and I see people and I talk to them. It's shocking to me that they believe that all of this is sustainable. They believe that the economy can keep going like this. They believe that it's a real economy, not a fake economy. See, everything right now, in my opinion, would be a fake economy. Everything since 2008 has just been stimulus printing. $20 trillion in debt we've added. Another $8 trillion that the Federal Reserve owns. That's like $30 trillion we printed just since 2008. Now, if we didn't print that 30 trillion, where do you think the economy would be? Do you think we'd be like having stock market at record highs? No, I don't think so. Do you think your house would have doubled? No, I don't think so. It's nothing to do with the economy. It's not sustainable. Oh, don't get me wrong. They're going to try to sustain it. Look, when things start to come down, when things start to crash, they're going to print more than 30 trillion that they printed since 2008. They're going to print double that, 60 trillion, maybe 120 trillion. But it's going to be like pushing on a string, trying to get that price to go up. And if they get that price to go up, we're talking about hyperinflation at that point, which is the worst thing that can happen to a country. You could look at Zimbabwe. Zimbabwe, sure, is their stock market up? Yeah, but are people rich? No, because the dollar doesn't buy anything. It's just frustrating to me that people think that this is real. People think economy is real. This economy is not sustainable unless you print this 120 trillion. But what would that do? That would hyperinflate us. Look at Weimar Germany, right? I mean, they hyperinflated. Did everybody get rich? No. Did prices go up? Well, in their format of the dollar, yes, prices went up. But do you realize that 25 ounces of gold in Weimar Germany, that could buy you the whole city block? The whole city block, because gold was real money. Their fiat currency hyperinflated. I'm afraid that's going to happen here. Granted, the reserve currency of the world has never hyperinflated, but I think no other government's been stupid enough to print the money that ours has done, to take advantage of that reserve currency. And believe me, it will go away. Maybe not tomorrow. Maybe we got another year. Maybe we got 3 years. I don't really know, but I know it's going away. The dollar as you know it today will not exist 5 years from now. Will not happen. It will be gone. I mean, that's just my take. I don't mean to bum anyone out. A lot of people, they say, are getting bummed out. There's another article I want to talk about real quick. They say people were getting bummed out because of this high 8% mortgage rate. I don't think that's why people are getting bummed out. I think they're getting bummed out because the price of the house is so high. Look, you bring that down, they'll come in, they'll give you cash for the house. It's not the rate, it's the price of the house. These are inflated. They're not real. It's not sustainable, but all my friends thinks it's sustainable. And that's why I have a channel, so I can talk with you, because me and you, we understand not sustainable. Anyways, I'm Tall Mike. Got a little carried away there. Get out there, everybody. Enjoy your Monday. I love Monday, so give me that thumbs up. Why not? Punch the subscribe button. I'll talk to you soon. Bye-bye now.